Hello, I am Amy. Welcome to the second session of the Account Double Any Trouble accounting course for beginners. I'm very happy that you've come here today. We are going to get right into the content. My presentation will consist of 3 parts. Firstly, property and financial claims. Secondly, basic business transactions, and finally, reporting assets, liabilities, and owner's equity. In this session you will learn how to apply basic accounting concepts and terminology. You will also learn how the accounting equation expresses the relationship between property and the rights, or claims, to the property. After studying this session, you should be able to state the accounting equation and define each element of the equation. Describe and illustrate how business transactions can be recorded in terms of the resulting change in the elements of the accounting equation. Describe the financial statements of a proprietorship and explain how they interrelate. The keywords in this session will be business transactions, account, accounts receivable, accounts payable, investment, on account, revenue, expense, withdrawal. To begin with property and financial claim. Asset. Now, let's move on to what is property. The right to own property is basic to a free enterprise system. Property is anything of value that a person or business owns and therefore controls. When you own an item of property, you have a legal right to that item. That covers financial claim to the property. For example, suppose you paid $600 for a mountain bike. As a result of the payment, you own the bike. If you had rented the bike for the weekend instead of buying it, you would pay a much smaller amount of money. But you would have the bike for only a limited time. You would have the right to use the bike for the weekend, but you would not own it. Businesses also own property. One of the purposes of accounting is to provide financial information about property and financial claims to that property. A financial claim is a legal right to an item. In accounting, property and financial claims are measured in dollar amounts. Dollar amounts measure both the cost of the property and the financial claims to the property. In our mountain bike example, since you paid $600 cash to buy the bike, you have ownership and a financial claim of $600 to the bike. This relationship between property and financial claims is shown in the following equation. Property equals financial claims. When you buy property with cash, you acquire all of the financial claims to that property at the time of purchase. Now we come to buying on credit. What happens to the financial claim, however, when you don't pay for the property right away? When you buy something and agree to pay for it later, you are buying on credit. The business or person selling you the item on credit is called a creditor. A creditor can be any person or business to which you owe money. When you buy property on credit, you do not have the only financial claim to the property. You share the financial claim to that property with your creditor. Moving on to the next point, the combined claims. For example, suppose you want to buy a $100 lock for the mountain bike, but you have only $60. You pay the store $60 and sign an agreement to pay the remaining $40 over the next 2 months. Since you owe the store $40, you share the financial claim to the lock with the creditor. The creditor's financial claim to the lock is $40 and your claim is $60. The combined claims equal the cost of the property. Your purchase of the lock can be expressed as an equation. Property equals financial claims. As you can see, 2 or more people can have financial claims to the same property. Only the property owner has control of the property. For example, suppose that you buy a used vehicle for $8,000. You pay $1,200 in cash and take out a loan from the credit union for the remaining $6,800. As the owner, you have control of the vehicle. However, if you don't make the payments to the credit union can exercise its legal claim to the vehicle and you will lose ownership. That brings us to assets. Property or items of value owned by a business are referred to as assets. Businesses can have various types of assets, such as cash, office equipment, manufacturing equipment, buildings, land. Another example of asset, petty cash, temporary investments, accounts receivable, inventory, supplies, prepaid insurance, land improvements, buildings, equipment, goodwill, bond issue costs, etc. Definition of an asset. Assets are things that the company owns. They are the resources of the company that have been acquired through transactions, and have future economic value that can be measured and expressed in dollars. Assets also include costs paid in advance that have not yet expired, such as prepaid advertising, prepaid insurance, prepaid legal fees, and prepaid rent. Liabilities and owner's equity. Moving on to the next section, let's take a look at what are the two types of equities. The owner's claims to the assets of the business are called owner's equity. Owner's equity is measured by the dollar amount of the owner's claims to the total assets of the business. The creditor's claims to the assets of the business are called liabilities. Liabilities are the debts of a business. They are measured by the amount of money owed by a business to its creditors. Owner's equity. The accounting term for the financial claims to these assets is equities. Let's explore the meaning of the term equities by introducing Anna Smith and her new business, First Delivery Service, organized as a sole proprietorship. Suppose First Delivery Service purchases a delivery truck for $10,000. Anna makes a cash down payment of $3,000 to the seller. A local bank loans First Delivery Services the remaining $7,000. Both, First Delivery Service and the bank, now have financial claims to the truck. The change of the financial claims. Over the years, as First Delivery Service repays the loan, its financial claim will increase. As less money is owed, the financial claim of the creditor, the bank, will decrease. For example, after First Delivery Service pays one half of the loan, the financial claims to the property will change as follows: property, truck, $10,000, equals creditor's financial claim, $3,500 plus owner's financial claim, $6,500. When the loan is completely repaid, the creditor's financial claim will be cancelled. In other words, the owner's financial claim will then equal the cost of the truck. In accounting, there are separate terms for owner's claims and creditor's claims. Definition of owner's equity. Owner's equity along with liabilities can be thought of as a source of the company's assets. Owner's equity are the words used on the balance sheet when the company is a sole proprietorship. If the company is a corporation, the words stockholders' equity are used instead of owner's equity. An example of an owner's equity account is Anna Smith Capital, where Anna Smith is the owner of the sole proprietorship. Let's look now at the next thing I'd like to talk about is liabilities. The creditor's claims to the assets of the business are called liabilities. Liabilities are the debts of a business. They are measured by the amount of money owed by a business to its creditors. Definition of liabilities. Liabilities are obligations of the company. They are amounts owed to creditors for a past transaction. And they usually have the word payable in their account title. Along with owner's equity, liabilities can be thought of as a source of the company's assets. They can also be thought of as a claim against a company's assets. Liabilities also include amounts received in advance for future services. Since the amount received, recorded as the asset cash, has not yet been earned, the company defers the reporting of revenues, and instead reports a liability, such as unearned revenues, or customer deposits. Examples of liabilities: notes payable, accounts payable, salaries payable, wages payable, interest payable, other accrued expenses payable, income taxes payable, customer deposits, warranty liability, lawsuits payable, unearned revenues, bonds payable, etc. Moving on to the next part, I'd like to explain accounting equation. The accounting equation for a sole proprietorship. The accounting equation serves as the basic foundation for the accounting systems of all companies. From the smallest business, such as the local convenience store, to the largest business, such as Ford Motor Company, companies use the accounting equation. The relationship between assets and the two types of equities, liabilities and owner's equity, is shown in the accounting equation. The accounting equation for a sole proprietorship is assets equals liabilities plus owner's equity. The accounting equation for a corporation is assets equals liabilities plus stockholders' equity. Liabilities usually are shown before owner's equity in the accounting equation, because creditors have first rights to the assets. Given any two amounts, the accounting equation may be solved for the third unknown amount. To illustrate, if the assets owned by a business amount to $100,000 and the liabilities amount to $30,000, the owner's equity is equal to $70,000, as you can see. Now, it's time to check your understanding. Take this quiz. The quiz will display in a new browser window. You have 10 minutes time limit. I will be back in 10 minutes.